Okay, so anyway, it's great that y'all came. Today, I wanted to share with you a strategy that I've been working on off and on probably for months. And I call it the my after earnings strategy. And the reason I think everybody is always kind of enamored with earnings. How do you trade earnings to make money? It's kind of like all the action in a month in one day or one night. And most people that trade earnings or hold stuff through earnings kind of realize it's kind of a crap show, right? You could have a great stock, it's going to do really well on earnings, and then it sinks 10%. Or a really terrible stock that you think is going to do terrible on earnings, and it's up 10%. So to me, it's kind of like you might as well just gamble if you're going to hold stuff through earnings. But after earnings, I think is a whole nother ballgame. So I wanted to kind of share and see if I can do this. If I get the slide showed. Oh, man. Yeah, okay. Sorry about that. It's supposed to be a slideshow. Let me just go back. Okay, found it. Okay, so with earnings events, what happens is implied volatility or risk in the options goes up, predictably as the earnings date approaches. And we know when the earnings date's going to be. We know what time the earnings is going to be. So we can use that information to sell credit spreads and take advantage of the implied volatility. So, like I said, many, use IV to sell options and hold through earnings as a result of that. But, like we just said, there's lots of problems with that, right? It's hard to be consistently profitable in that strategy. But after the earnings are announced, the stock's going to either go up or down. And what happens is the earnings will also decrease. There's a IV volatility crush. And we take advantage of that when we sell options, when we sell credit, and IV goes down, that helps us be profitable. And the cool thing about earnings, after earnings trades, is there are websites or information where we can actually see a particular stock, how it does after earnings historically. So you can see a stock, and I'll show you a website that will track that for us. But it's really cool because if you look back and you say, for the last 2 years, or you want to go back further, every time this stock goes up after earnings, it goes up further after, 7 days, 14 days, 21 days. So you can build a trade strategy to take advantage of that. And you're not going to be right all the time, but your odds of your probability goes up even more. So it kind of takes advantage of the IV dropping and the fact that we know what the history of the trade is going to be. So the thesis is that we're going to take advantage of the volatility crush. And the good thing is it happens every time. It's not like if it will drop, it will always drop after an IV. And the second thing is we have this historical data to help us decide what stocks we want to trade after earnings. Does that make sense? Mm-hmm. So that's kind of the thesis of this strategy. And if you guys have any questions along the way, don't hesitate to ask. So ideal market conditions. Well, one is, the higher the IV, kind of the better, right? Because we'll know the higher the IV, the more the credit is going to be on the options. And we want to know, based on our review of the past history, it has a consistent, we can make, a consistent decision on what to trade, how far out to go, what credit. And the other thing is we want to make sure we're not trading stocks that don't have good liquidity. Because these are trades that you're going to probably want to be in for a pretty short period of time. So when you want to get out, you want to get out. So if you don't have good liquidity and good open interest, you're going to have problems. And then another thing, I don't do this personally, but a lot of people use this strategy as kind of a wheel strategy. They're going to say, I'm going to sell something below where the current price is. And if the stock drops, it's still going to be either above where, where my short put was. And I'm willing, if it drops lower, I'm willing to take the shares. Because now I know now I've got a whole quarter that I can sell calls against before the next earnings event. So it's an interesting idea. I don't do it personally, but it's just a way, what we want to look for is, the high IV, good history of what the stock normally does after earnings, and then it has good liquidity. So that it's pretty simple, and there's a lot of good sources to figure that out. Okay, so in terms of stock selection, again, high volume and liquid options. One of the things that I always tell people that if you don't know the stock or the ticker, it's probably not one you want to trade. There's some weird little, letter and you're like, I'm not sure what they do. Probably not one you want to trade, but there's a ton of them that come up because every, Fortune 500 company announces earnings 4 times a year. So you have lots of opportunities. And really, if you master that 13-week group of trades, you can do it over and over all year long. The other thing is, with IV being so low these days, it's hard to get good premium, right? I mean, when you're selling, 0 DTE, SPX, and things like that, when the options are so low, it's just hard to get great credit. So with earnings, you got an implied volatility jump that's going to be way higher than what the overall market is doing. So that's another reason why looking at earnings trades or after earnings trades makes sense. And so the other thing you want to make sure is when you're doing these trades that what other stuff is coming up. Are there like a Fed meeting that's coming up? Or something that could also impact price. So there's a lot of like meetings these days that impact the market, right? Like this afternoon or tomorrow morning, the CPI number will be coming out, inflation, and that can have an impact on the overall market. So you just want to know what other events are coming up that can impact the market. And the other thing is you want to look at, where are your, support levels? Where did the stock come down to that that you think, the stock's going to stay above this level, even on an earnings. So that helps you determine, what is a good strike to sell. So any questions so far? Okay, so one thing that I've learned on trading these strategies, I haven't had any luck selling bearish call spreads after earnings. I've tried them, they never work. So I don't know why, but it's just a bias of mine that I'm just going to do put spreads. I'm just going to look at it from a bullish perspective because the market's usually up 80% of the time. I want to look for bullish setups. So the average, so what we're looking for mainly is that IV crush, right? So we want to sell credit spreads 7 to 15 days after the earnings to take advantage of that IV crush. Now, I have gone out and sold monthly options, and they work too. So, but the main advantage, if you sell like a near dated option after earnings, that IV is going to drop, which will impact the pricing of that credit spread. And so in terms of strike selection, I want to look for, what's a strike price that is below the average, what's the worst move that it has made over that 5 to 21 days, and sell my put spread below that. So that enhances my odds. So we're already selling like probably a 15 to 20 delta. So we have, we have pretty good odds to start with, and this just helps us. So let me see what, and in terms of credit goals.
I was just gonna ask, do you have a copy of your handouts available for your slides?
I'll send them out after. Yeah. Yeah, so you don't have to take note, you don't have to write everything down, but so I use the between 15 and 25 delta in terms of the short puts that I sell, and I always do a spread. So I'll do a $5 wide spread or even a $2.50 spread, depending on what I can get the most for it. And I'm looking for generally 50 cents to $1 credit on these trades because I'm not in them very long. And so if I go out a month, I'm looking for $1. If I'm going a week, I might go 50 cents. That would be a bare minimum in terms of a
As
trade.
far as your target of where you want your put spread, you want to be looking back at a history of 20 to 15 days.
Yeah, what I'm actually looking at, and I'll show you in a second, is historically, where has this stock moved 5 days, 7 days, 15 days after the earnings event?
Oh,
So, you can already, know if it always goes up after earnings, so that improves our odds, right? And I'll show you a website that tracks that really well. Okay, so exit rules, pretty standard for credit spreads. I'm looking for about 50% credit, credit capture after the trade. If the trade doesn't work, I will use a 100% stop loss. So if I get $1 and it goes to $2, I'm out of the trade. And or if there's a support level, like you'll see on a chart, like if it breaks 100, I don't want to be in the stock any longer. So you can use that level as well. And then the other thing is you want to close this trade 2 to 3 days before expiration to avoid gamma risk. And so it's just one of those things you want to be in and you want to be out of this trade. So
so if it goes against your spread, wouldn't you care to just let it expire?
no, because remember, if you get $1 on a $5 wide spread, you have $400 of risk. So we don't want to lose $400. So if it doesn't work, and we'll know pretty quick that we want to get out for $100.
Right, but if it's going in the opposite direction.
Oh, you mean going in our favor?
Yeah.
You can, but sometimes what you'll see is like a stock will maybe gap up 3% the first day, maybe another percent and then the profit takers will come in and drive it back down. So you don't want to be like sticking around too long. You want to hit your target, reuse your capital. Good questions. Let me see, there was a couple of questions here in the chat. Okay. I'm not do this anymore. Sorry about this. Okay, so anyway, so here's just an example, and this one actually has an earnings announcement tomorrow before the market opens. JP Morgan. So it was when I wrote this up at the beginning of the day, it was trading at about 286 per share.
Yeah, it's just 289.
Okay, and so it announces earnings at tomorrow morning before the market opens. And there's a website called Earnings Whispered that you can go to, and you can type in the ticker and it'll tell you exactly what time they announce their earnings. So it's, they could be at 8:55, it can be at 6:55, they're at 6:53. So they're pretty precise when they release their earnings. So if you look on the charts, the implied move for this week is about 3.6%. So what they're saying, the options are priced in that the stock is going to go up or down 3.6%. And so that puts you between 276 and 297 after earnings. So that's kind of and JPM offers weekly options because you want to have weekly options. We don't only sell monthly, and it has great open interest. Everybody trades JP Morgan, and it has great liquidity. And Bar Chart, who I use a lot, is another website. They have it as a strong buy. So it's a strong company, and it has earnings, and it doesn't have it's not a big move for this. Okay, so this is a shot of a screenshot of Option Slam. And what they do is they gather information after earnings, and they will show you here's where the stock has historically moved after earnings, the day at the open. And then here is the 1-day move. So at the end of the day, after they announce earnings, this is what JP Morgan has done. It can go up, 4% or down 6%. So pretty wide range. So it's a pretty cool website. It tells you the highest and lowest it's been during the day and where it closed. So that's good information to at least know what to expect on the move.
This is bar chart, man?
And this is Option Slam.
Option what?
Option Slam.
Options.
Okay, now this is the one that I really think makes a lot of sense. Let me see if I can get 8 out of here. Okay, so this is the post-earnings history of the stock. So you can see that this is where it opens, right? This is where the stock finished at the end of the first day. And then you can go back here and say 5 days, this is what the stock has done. 13 days, 21 days, out to 55 days. So it gives you great information in terms of what do we expect the stock to do. And if you look at this, if you exclude this one event where it was down 3.6%, and go out, 5 days, the lowest it's been is down 1% at the end of 5 days, or at the end of 13 days, it'd be down 3.7%. So if we're selling options 5 to 10% below the price, that helps our odds. Does that make sense? And so the 21 days, if you exclude this losing day, only 1 day out of nine events was it down, 3%. All the other days, 8 out of 9, it was up. So that's pretty good information. If you set a trade up and you know that you have a really high chance if the stock moves up after earnings, then you sell a put spread and you have this kind of data, you know that it's your odds of winning the trade are pretty high.
And this is Option Slam too?
This is Option Slam, right? So, and I'll show you the website later if you like, but it's a pretty cool little website, and it'll tell you, what stocks are coming up on earnings, how they do, and stuff like that. Any other questions?
So all it needs to go is back about 8 quarters.
Yeah, you could actually go back,
Oh.
like 10 years if you want to.
Oh,
I just say, 2 years is pretty good history for me. I mean, but you can go back, probably to the, probably 10 years if you wanted to. And you can drop this into an Excel spreadsheet and track that stuff, but if you just eyeball it and say that, a stock like JP Morgan, which is pretty highly rated, if it gaps up or a small, gap up, selling a put spread after earnings is kind of the, nice setup. That makes sense? Okay, so, I, being a numbers geek, I went back and tried to do a little analysis of the stock. So, the stock went higher, 5 out of the last 8 times. So 63% of the time, the stock actually went up at earnings. So it announced earnings and it went up. And the range went from 4.4 to a negative 6.6 or 6.46. So 5 days after the earnings event, it was 75% of the time it was higher. And then excluding that one day, the most that went down was 1.96%. So pretty solid background on the trade. So my takeaway is if this stock has a positive move in the morning, I'm going to sell put spread in. So that's kind of the after earnings trade idea. Does that make sense? And so, I would have, I would look to sell a put spread around 280. So you could either sell the 280, 275 put spread, or you could sell the 280, 270, 750 put spread. Either one, just depends how much risk you want to take on. The return.
what's your expiration?
I would probably go out about 14 day or probably next Friday is probably what I would do. This Friday's probably a little too soon. And then the backup would be the monthly.
But you still have more, I'm sorry.
Go ahead.
Oh, I was gonna say, you still have more intrinsic value this week than next week, right? Or is it steady, you think, or starts to peter off?
Well, there's IV is higher in the closest period. So the further you go out, the IV is a little bit more normalized. But if you, sell the 1 week trade, you're going to have plenty of IV if you if you put the trade on in the morning of the announcement. The IV hasn't completely dropped yet. You could even put it on later in the, that first day. That's kind of the way I've been doing it.
That's what I was gonna ask, the time period.
Yeah, I mean, what you don't want to do is you don't want to put it on at 9:35. You want to give it a little bit of time because it's going to move around, right? We all seen that, right? Those big wicks where it's up and down. So you don't want to jump in the minute. You want to look. I like to look at it on a 5-minute chart, and if it goes up and it starts to come down, when it levels off, kind of thing. That's when I'll put my put spread on. So a lot of times I'm putting them on at 10 o'clock, even 11 o'clock.
Do you also use the chart information as to the pattern of how it's flowing? If there's certain resistance or support levels?
Yeah, well, I've already kind of determined where there's a resistance level kind of thing. But that's more at where I'm gonna get out. Okay. Because if it breaks that support level, then I don't want to be in the trade, kind of thing. But this is going to be mainly I'm looking at where did the stock, how did it move after the market opened? Because pre-market, it'll gap up 2%, right? Then the bell rings and it might go up and it might come back in. A lot of times it comes down a little bit, but if it stays up, 2%, then I'm looking to sell a put spread because 1, I know I have the elevated implied volatility, and 2, I know that I have a good high probability setup by selling. Still, I'm selling a 20 delta put, so I have an 80% probability of winning, and I know what history has done on the stock. So, that makes sense? You like it?
Mhm.
So, and that trade that I set up, according to Tasty Trade, it had like an 85% probability of winning. So, those, if you put enough of those on, you use good risk management, that's a pretty good system. Additional information. This is pretty helpful. If you're looking at something like JP Morgan, and it'll announce tomorrow, but like the next day, maybe Morgan Stanley might announce. I always look to see, how did JP Morgan do, or how did, Wells Fargo do? Because they're going to do the same. I mean, you can have you have competitors, but they all tend to do, that industry will do pretty close to the same in terms of their earnings. So I always, if you have like later in the week, other investment firms, I'm going to look and say, well, how did JP Morgan do? Then I have a better confidence that that one's going to do very similar. Like if the first airline does bad, the second airline is probably not going to do a whole lot better. And again, I wait about at least the first 30 minutes after the market opens when I put them on. Sometimes I'll wait till like 11 o'clock. So don't want to be the first guy to jump in. And the other thing is, for those who say, I'm willing to take the shares, that's usually a lot from people I talk to, like when the trade really moves against them, they say, well, I'm willing to take the shares. What I would say is, decide beforehand. Are you going to take the shares, or you're not going to take the shares, and stick to it? Like if you said, if JP Morgan drops 5% and I get in my put, I want to know, am I going to take the shares, or am I just going to get out? So if you make that decision beforehand, it's not a panic decision. It's not an emotional decision. Again, I don't trade bearish trades after earnings. I just haven't had good luck with it. So
Even if the earnings were down.
yeah, like if I anticipate the stock doing badly at earnings, and I say they're going to do bad and they're going to stay bad, and so I'll sell call spread. Inevitably, it goes up and takes me out, so I just quit doing it.
Nike did that.
Nike's a perfect example. It's kind of one of those ones. Nike can't go up, right? All the trouble and
Yeah.
stuff, and then it blows through
Blows
earnings. But the good thing about the after earnings trade is, at least you know what Nike did after earnings, right? I mean, if you held it overnight and woke up the next day and said, I think Nike's going to go down 10%, and you wake up and it went up 10%, that's the crapshoot that you don't want to be in. After earnings, it went up 10%. Now, what do you want to do? So, and me personally, I'm not going to do bearish after earnings trades. Let's see. And then the other thing, just be aware of other events. We talked about that already. And then I use option slam and bar chart to help me figure out stuff ahead of time. And here's some early results that I did on this trade. I won about 80% of the time. Average win, including my losers, was about 8.6% return on risk. I was in the trade about 8 days. So the other thing down here where you'll see I have the amount of wins per contract and the amount of risk. You use a lot of this capital over again. You're only in this trade 8 days, so you're using that capital over and over again. So if you took, that you had 3,000 allocated to it, it'd be like a 22% return on capital if you just reuse the capital. So
You lost on Palantir.
I did. I probably went bearish.
Do I?
Not the Palantir. Oh yeah. So
How did you lose on Palantir?
yeah. So yeah. So there's a few losers. One was a scratch trade, but this is just some examples. And the good thing is you're only in these trades about 8 days. So some of them you're out. Well, I like it. 2 days, so 1 day.
Yeah.
Um,
That's quick.
So anyway, before I show you the websites, our next meeting will be on August 12th in here. I think that's a Tuesday. And we've already booked the room, so that's good. And so if you like, I can show you the Option Slam software so you could look at some. Let me see if there's any questions. Tammy asked, how long before earnings are you entering? I'm actually entering them after the earnings and generally wait, probably that first, at least 30 minutes to up to like a couple hours. And that, let me see. Oh, and the other one that somebody asked about was option earnings whispers. That's a great website as well. That
Are those paid prescriptions or anything?
Option Slam is a paid one. There is a free version, but it doesn't give you any history. Bar Chart has a free version that gives you a ton of information. And Earnings Whisper has a free and a paid. And I only use the Earnings Whisper to know what time the earnings are going to be announced. I tried to use their data to get anything, and it never worked for me. So
It's confusing. You have them all.
it does. So, I want to show you. Here's Option Slam. So, okay. So on option, let me log in so you can see what it does. So some of the cool things about option, if you want to look at a particular day, like say we want to look at tomorrow, what earnings are coming up tomorrow? We want to look at only stocks with weekly options, and we're going to do $50 minimum stock price. This will tell you, these are all the stocks that are going to have earnings on the 16th before the market opens. So, and then there you can click, say if we want to look at Goldman Sachs. You can click on this and it will give you all of the past earnings events. And I go back 2 years just because you can go back. I think they have 11 pages of data. So if you want to get all of them, you can get all of them. But then this one just tells me, how did the stock move at the open? And you can see here, it does pretty dang well, right, at the open.
And it doesn't.
And so this is as high as it went or as low as it went, and this is where it closed, the day of earnings.
That's just day one though.
That's just day one. And then if I want to look at the post earnings, they have a tab up here for post earnings. And then this will tell me,
Oh, that's the one.
this will tell me what, after 5 days, what's the best and the worst the stock has moved in 5 days or 14 days or 21. And so what I'm looking for is a really solid stock that will do well if it has a positive earnings event. And then I want to sell a put spread against it.
Looking at the 8 days for the Friday.
Yeah, probably. Yeah, so that's kind of like, so in this particular case, I would probably want to sell at least 5% below the price, right?
And you maintain yourself in that bracket below the.
Yeah, I want to go as low as I can. If I can go 10%, that's even better.
Sure. You never know. There's always a 100-year storm event.
Yeah, I mean, like if we went back and said, I want to see all the history, there's probably, let's do that, just see what it looks like. There's probably a day that it just blew up. So here's all the history. And I mean, really, there isn't any really terrible down days, right? You can look back as far as you want. Like if you say after whatever, 8 days, the lowest, there's one at 6%, but mostly
There's a 9 or 10% there. 22. All right, 9.72.
Yeah, so I mean, if you go back, long enough, you're gonna find that even a good stock's gonna have a bad earnings event. But the data is kind of the key thing. You want to look back and say, is there a pattern or is there a higher probability that this trade is going to be, hold up after a positive earnings event? Then you can sell a put spread. And you're taking advantage of the IV being elevated, so you're getting more credit to sell that credit spread, and it's going to drop as the earnings event passes. Kind of like a wave, it just kind of goes and comes back down. Yes,
Are you looking for a particular level on the IB?
I'm not particularly, because if the stock, we know it's going to be elevated from its normal level. And if it has a good post-earnings history and the credit that I can get for it is, meets my levels, then I'll look to take the trade. The higher the IV, like if you looked at a really small stock or one of these real high flyer stocks, take even a Tesla, when it goes to earnings, its IV is going to be way higher than a JP Morgan. Every time. So it's all kind of relative. Tesla IV is higher than JP at earnings, kind of thing. So
On a usual day.
on a usual day. So, but what you're looking for is a higher implied volatility than it's normal. So if it's say it's a 20 IV and it's at 45, that's great because it's going to come back down after the earnings event. So, and the other thing is, if the stock goes down, I usually pass on the trade because IV will stay up if the stock gets tanked. So you don't get that IV crush if the stock goes down. So that's another reason I just don't do the bearish side of it. I'm trying to convince you all never to do the bearish trades. But so
IV shows up on the platform.
it does. It'll show you the IV for that particular expiration. And you can look at it and say, like this one is, 45 and the next one's 35 and then it's 30, further out you go, the IV drops.
And it changes, right? On a constant
It
basis.
changes,
IV
right.
changes.
Yeah, because what'll happen is like tomorrow when JP Morgan announces its earnings, its IV is going to be as high as it's going to be. It's not really super high, but it's higher than it's going to be. And as the day goes by, it kind of drifts back to normal. And we take advantage of that by selling credit spreads.
Right, so if let's say JP Morgan tomorrow opens lower,
Mhm.
if it opens lower and start to trend down, you will not.
I just pass.
You pass on.
Yeah.
Yeah.
Yeah, what I normally will do is I'll probably, like today is, this is like the kickoff of earnings season. So there'll be tons of earnings, like, remember we showed the calendar, there were like 4 good names, right? And what I would probably do out of that list when I do my homework, there are probably 3 that I would take. You know what I mean? So if 2 are up, then I'm okay, what's the best setup of these 2? And then I'll pick one of those. But if it went down, say JP Morgan gaps down 5%, I'll just pass. I don't try to force it, kind of thing. And it could. I mean, there's like a 1 in 4 chance it's going to go down, right? And so we don't need to. There's too many good opportunities. So especially in the peak of earnings season. Another thing I wanted to show you guys is how I look for earnings. Or this is bar chart, and I can go out and see from here, what stocks have earnings coming up. You can also, so this one is a good way to look for dividends as well. This is what I primarily use this site for, is what stocks are going ex-dividend for covered calls. But the bar chart has a great little calendar as well. So you can look up here and it says earnings calendar, and you want to look at a particular, day. You can do a range of days. And then it will print off, like these are all the stocks that have earnings on the 16th, before the market opens on the 16th. And, from there you can do your homework. So that's kind of that's my process in looking at after earnings trades. Yeah.
A friend who's logged on, they can't see what you're talking about.
Oh. Bummer. I don't know how to fix that. Just tell them apologize.
Click on the person screen,
Mm.
you can maximize that. You can maximize it. Then it'll give you share video. There you go, share.
Okay, thanks. I know this stuff.
There you go.
Okay, so here's the, sorry about that, guys. This is just the calendar on Option Slam. And it shows you, what stocks are coming up that have weekly options and over $50. So, that is, and if we wanted to look at since you guys didn't see this, if we want to look at what's the history of Goldman Sachs after, how does the stock move after when it opens after earnings? This is what it is. And then we can also look at the post earnings history here. So that shows you, by day, right, how's the stock go. So that's probably another really nice setup. So, and I would go through bar chart to see, are the technicals and the fundamentals pretty strong and ahead of time. So I'm kind of waiting to see, okay, out of those stocks, which one gapped up, and then start looking at that for, what credit spread to sell. So anyway, sorry for all the technical,
You said you use Tasty also for kind of predicting which way the stock's gonna go after earnings?
I use Taste, it just shows you what the expected move is. On a
But I think
predicted.
you said it was like 85%.
Oh, if you set up a put spread in Tasty, it gives you what is the probability of profit and what's the probability of profit at 50%. So,
But is that mathematical or is that based on something?
I think it's based on whatever their analytics show. I mean, and basically, if you sell a 20 delta put spread,
Right.
you'd probably have an 80% chance probability of success. So, that's a lot of that's built into that kind of thing. If you sell a 50 delta put spread, you probably have a 50% chance of a profit. So, and so the further you go out, and the difference being on selling the 20 with IB being higher, you get a little more credit than you normally would. So, anyway, that's all I had in terms of the after earnings strategy. It's a cool little strategy. It's fun to do during earnings season, and it keeps you, like waking up the next morning and saying, like, oh, I thought the stock was going to go up 5% and I went down 10. You don't have those kind of headaches. You can kind of use the data after earnings and you still have the IB be relatively high to make a good trade. So, any other questions? Okay.
You said after about 2 weeks, the IB is still good. After that, it starts to dwindle down.
It's actually probably like a day or so, 1 or 2 days, and it's going to be back to normal.
Okay.
So you don't want to be, probably doing this trade.
2 weeks.
Yeah, you don't want to hold.
Following week.
Yeah,
Following week
you're going to
is-
do this trade the day
The
of
day of the
earnings,
trade. That'd be
pretty
nice.
much that, you don't want to. I'm usually, if I don't get in it by like lunchtime, the
Then
day
you're
of,
not
I'm
out.
just past.
Cause there's nothing there.
Right, you don't have any advantage at that point, so, so that's kind of the, and, but, there's an art, you don't want to do it too soon, you don't want to be in there like at, 9:31 putting the trade on. Because then it could sink down,
Yeah.
and that happens a lot, particularly on weaker stocks where it gaps up 10%. I think everybody is like, holy crap, I'm gonna get my profit and get out of this thing. And take it right back down where it was. So you want to let that thing go up, come down, because it's gonna, profit takers will jump in, right? I mean, any stock that gaps up, there's usually somebody that says, it's good enough for me, I'm taking my profit, and that's gonna pull it back down. And once it kind of levels out, that's where you want to jump in. Great questions. Okay, I'm gonna stop the recording.